Okay, welcome. Good morning, afternoon, or evening from wherever you're joining us in the world. Thank you for taking the time out of your day to be with us. I hope you will not leave disappointed and ultimately be able to navigate the charts from a clearer perspective. Good day, guys. Thank you. Nice to see some regular faces here. Excellent. Okay. Right. So today's presentation is a combination of a recap and, shall we say, a progression from last week's supply and demand webinar. While there are traders who completely cold shoulder supply and demand trading techniques, I have been a believer for many years now. Before I continue, I assume audio is clear and the welcome slide is visible, as the chat box is relatively limited. If there's any issues, do let us know, and our friendly support team will try and get you back on the road. As I said, thanks guys, excellent. As I said in last week's webinar, today's session, part 2, is here to reaffirm supply and demand trading techniques. Again, please understand that these ideas are how I personally view supply and demand in the markets. I know there will be points you may agree on and other points you may find a waste of time. And that's absolutely fine. You have to work with what works for you. What fits your trading method may not fit mine, and vice versa. This is what makes trading such an interesting business. And to round off the intro, let me just quickly introduce myself for any newer faces here today. My name's Aaron Hill, and I am a market analyst here at FP Markets. My experience is largely focused on technical analysis, mainly price action, though I am beginning to incorporate fundamental analysis for longer term study. I am, with a little bit of luck, going to receive my CFTe designation at the beginning of 2022. So as usual, any questions on this program, do feel free to fire away. Right, excuse me guys. Right, before we get things underway, bear with me for a minute to go over the disclaimer on screen. So the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. FP Markets does not give any warranty or representation as to the accuracy, reliability, or completeness of the information contained in this material. Look, guys, as I say in each presentation I give, the disclaimer is in place to say whatever we discuss here today is educational. It does not constitute investment advice. Look, guys, it would be good if I could just ask, for anyone that was with me in part 1, did they look at supply and demand at all? Did they find using the 8 concepts I showed helpful? Just let me know in the chat box while I run over to today's agenda. That would be great. Also, can I please ask you to have some live charts on your screen to follow what I talk about when we hit the charts, and please note down any potential setups you see in the market for this point. I know overnight, recently we've seen some really big moves in the market, so it would be good if you could highlight any areas you see that's worth looking at. So as for the agenda, the first port of call will be a review of technical supply and demand. This is a section where we'll touch on the concepts we looked at in last week's session. Do not worry too much if you're still unsure following this section, as we'll then move on to more of a detailed explanation of supply and demand. where I plan to go over each of the 8 concepts, supporting points to locate supply and demand in detail. We'll then shift things over to the live charts to learn and review our understanding of supply and demand, and then look at rounding things off with some live analysis. Potential areas in the future, and also we can look at taking on some questions. Now, guys, it would be good if questions are left until this point, unless I specifically ask, as I'm 90% sure the questions you may ask at the beginning will be answered throughout the presentation. Now, we do have some comments. Okay, excellent. All right, we've seen some of the attendees have been looking at supply and demand. Brilliant. William, try VSA trade guide. I've never heard of that. Could you explain what that is? And maybe we can share that with the attendees here. Thanks. So this next slide here shows the 4 basic supply and demand variations you will see on the charts, and this was shown in the previous webinar. So first up we have the rally base rally, or RBR as it's commonly called, the drop base drop, or DBD, the drop base rally, or DBR, and finally the rally base drop, or RBD. Those who were with me in part 1 will recall I prefer to focus on the upper 2 formations, the rally base rally areas and drop base drop zones. Though as I also underlined, this does not mean the other 2 zones, the drop base rally and rally base drop areas, are useless, as some traders have found success using these areas. So as a quick refresher, okay, we have some, okay, which 2 were your preference? We have a comment here, which 2 were your preference again of the 4? I hope, yeah, okay, Daniel, excellent. Yeah, I answered that. So my preference is, of course, the rally base rally areas and drop base drop zones. Again, that's not to say that these other 2 are not of use, as I know some traders do find these useful on the charts. So as a quick refresher, the rally base rally zone is a form of demand, and it's established within a defined uptrend. As I said in the previous presentation, it's defined within an uptrend or at the beginning of a possible move. As you can see on the slide, the rally base rally forms an initial move which transitions into a consolidation, or which you would know, we would label as a base, and this follows through with a subsequent move to the upside. Again, for the drop base drop, this is literally the mirror opposite of a rally base rally, and this constitutes an initial drop, follows through with a base or a consolidation, and this follows through again to the downside, and this is the drop base drop. Again, guys, these are continuation patterns. So onto the drop base rally. This forms what's known as, a bottom or a cap on the chart. It's a basic configuration, and it's constructed in the form of, so we have initial lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, and then we eventually transition into a base. Now, at this point, we clearly do not know this will be a drop base rally, as we do not know with the rally base rallies or drop base drops when they're in consolidation form. We only know this is a drop base rally after price has produced a strong move to the upside. So literally, again, mirror opposite, guys, of the drop base rally. This is a rally base drop, and this forms with consecutive higher highs, higher lows, higher highs, higher lows, and eventually this transitions into a base. Again, we do not know. This will be a rally-based drop until we see a defined downside move. Okay. Now, these are found at trend reversal points, but they can also be found. They can also be found at. They can also be found within a prevailing trend. So a drop-based rally would be found within an uptrend. So these areas would be good for, buying dips. So we have an uptrend forming higher highs, higher lows, higher highs, and then comes down for a retracement. And it's at this point we might form a drop-based rally, which can be traded if price retests the area. Okay, so I hope this gives you enough information. And look, for the rally-based drop, it's simply the same as a drop-based rally, but it's formed where it's formed within. It forms a top or a cap again in an uptrend, or can form within downtrends and can be ideal areas to sell off from, should I say. We have some comments here. Sorry, I can't hear you. Is the sound okay now? Is the audio coming through okay? Okay, I think that might be on your side because other attendees are saying they can hear me. I apologize for that. We also have a comment from William. In answering your comment, Trade Guide is a company which uses VSA volume spread analysis based on the Wyckoff principles. Yeah, William, I briefly looked at VSA before, but I've not gone into detail with it. I also looked at Wyckoff principles. I haven't gone into detail with the Wyckoff methodology though, so I haven't got anything to say really on that in this presentation, but thank you for highlighting that. Right, so any questions on this point here, guys, just before I move on? Hopefully that was quite basic and should have been easily understood. As I said, this is a follow-on from our part one. I don't see any questions coming through, so I'm going to spin over to the next slide. So here the objective is to recap and go into a little more detail regarding the 9 points you see at this point here. I largely look at 8 of the excuse me guys, I largely look at 8 of these points to validate a zone. The differences part at point 9 is simply to identify the difference between support and resistance and supply and demand. Although others may have a different interpretation of this, I have always viewed supply and demand and resistance as different concepts. So for me, supply and demand tends to offer more of a broader focus, while support and resistance traditionally is often a defined level, though I would never trade based on one individual price point. Supply and demand is also, for me again, shorter term, if that makes sense. Supply and demand is formed of current prices, while support and resistance can go back years, sometimes even decades, flipping between support and resistance. Though I believe, all support and resistance levels were originally supply and demand areas at one point. So as I said in my last webinar, though both support and resistance and supply and demand, in my view, could be called either supply or demand or support and resistance. This is just a way I have chosen to define them. Do note, supply can also become demand and vice versa. But once, say, that demand is breached again, for me, we are looking at a support and resistance base going forward. I hope that's clear, guys. If not, I can quickly demonstrate this on the screen with the pen. Okay, so looking at the 8 points to locate a supply and demand area. Let me just get the pen set up. Okay, so we're going to kick things off with, you have to excuse my art here, guys. It's not the greatest, I know. And this is what we're looking at. So this is, this is a base rally area. So the first point we're going to touch on is strong movement out of the zone. So look, before I go into this, it might be worth touching on liquidity and inefficient and efficient price action, because this is something that made me really understand what supply and demand, how supply and demand can be used in the market. So, and a liquid market generally has a chaotic moves and sometimes large gaps. This is due to the lack of buying and selling volume. So a liquid market, which can also be called a deep market, is one where buying and selling is, shall we say, plentiful. As traders, we all require liquidity, right? So if we want to enter the market, a trader has to be willing to take the other side. And again, if we want to exit or to offload a position, again, another trader has to be willing to take the other side. This will be difficult in an illiquid market. Now, I'm not going to go into detail regarding market makers and who's on the other side of your trade, but let's just keep it simple here. For those 2 points, if we need to enter a market, we need a trader on the other side of that position to enter, and again, to exit, there needs to be another trader willing to take on that position. So you will note in equities, gaps are common since there is a defined open and close time. But with FX, we have pretty much continuous trading around the clock, well, 5 days a week, and we rarely see gaps. What we do see, though, is our large one-sided price moves, sometimes referred to as inefficient moves. Some traders actually will trade into this efficiency. So we have a large move to the upside, and then traders will sell into that inefficient move. Back to preferably a demand or a supply. So inefficient charts simply highlight a lack of liquidity, so a lack of willing buyers or sellers. Once that inefficient move halts, so a strong move to the upside finds a cap, the market tends to want to fill this inefficiency. So just literally, guys, think of this as a price gap filling, and this, once filled, is where we look to for those trades of supply and demand. So strong movement. So we're looking for an inefficient move, a strong move forming out of the base rally here. At this point, within this area, we do not know what it's going to be. I mean, there's going to be some traders thinking it's a flag, a bullish flag. At this point, we have no idea what's going to happen. We could even go to the downside, right? And we could form a rally-based drop. But once we get the breakout, to the upside, we know a strong breakout to the upside. We know we've got a potential. At this point, we still don't know if, even with a strong move to the upside, we still do not know if it's a viable demand, according to my definition, that is, of course, guys. So, identifiable trend. This should be really self-explanatory. I look for rally-based rallies or drop-based drops to form within defined trends. Now, of course, the market is fractal and there are trends on different time frames. So, for instance, we could be in a defined downtrend on the daily time frame, but on the H1 we could be forming a pullback, which from the H1 is an uptrend. So we have to take that into consideration, and that is the second point I look at, an identifiable trend. So how you identify those trends is usually trader dependent. Some traders use moving averages, some traders use trend lines. There are the ADX indicator is another one. there are a number of ways you can identify a trend. For me, I usually just eyeball the chart now because I've been with charts for so many years now, looking at higher highs, higher lows, and lower lows and lower highs. So yes, really, we need an identifiable trend to confirm our second point. So let's just tick that off. So duration. For those who were present with me in part one will remember, so I know some traders that will trade these areas if price has gone higher, 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 and then comes down and then comes down and then hits this area. I know that. I know some traders will do that, and that's fine. But do bear in mind, they look at the history at this point here. They look at what's formed just above this area. They look for what's known as stop loss orders to form within this area here to be able to take a trade. For me personally, I tend to not look at this kind of formation because I feel that we have bearish sentiment against the area, and you're initially looking for a reversal here, aren't you? I prefer to go with a continuation. So what I'm looking at is a zone that forms like this, pushes to the upside, okay, and it does not form another consecutive higher high in this point. Instead, we come straight down to fill that inefficient move there. And this is where we normally see the reaction. It's on the first time back, guys. We're looking for this first time back. It's fresh. It's in the market's memory. Yes, it's just something I look for, and it's something I've noticed over the years. You'll see on a couple of examples I have. For those who were with me, again, in part one, we'll note the Euro Pound 30-minute chart was an interesting area, which we'll go over at the end. It's very similar to this. So yes, to answer the question, duration, I prefer to look for the shorter term areas over the longer term zones, which are extended into, which can be months or even years. Right, next point, fresh. Now, there's a number of definitions on the internet with zones, regarding as zones of freshness. How I determine whether a zone is fresh or not is I look at if it's a reaction to something. So if this area, what I mean by that is I don't really want to see this area react off a defined resistance zone. So imagine that comes down here. Okay, I hope you're getting this, guys. I hope I'm clear with what I'm saying. So this is a resistance here. We've broken above that resistance, and now we're consolidating off that resistance. We're using that resistance, okay? I'm looking for decision points. I'm not looking for reactions of support and resistance. And also with fresh, you've got to take into account, we do not want to see price come up and stab into that area and then come up and then subsequently rally to the upside. What we want to see is an area. I can't delete this previous part, guys, but just imagine this point is not here and we have a fresh. So we have an inefficient move pushing out of the zone, and we have no lower shadows stabbing into that area, effectively reducing its strength. I hope that's clear, guys. Okay, so fresh. Previous resistance has become new now support. Yes, the kid. Yes, previous resistance has become now support. Yeah, this is the point I'm making here, but I don't like to see that happen with. I mean, look, guys, if you're a support and resistance trader, this is ideal. This is ideal, right? We have a defined resistance here. Price comes up, and we retest that area, right? So this is where long traders will be in. But if I'm looking for supply and demand, I do not want to see this happen. I do not want to see it have any connection with anything. I want to see it alone on the chart, effectively as alone as possible. So I don't. So and that goes the same for stacked supply or demand. What I mean by stacked supply and demand is literally this area here forms another area there. Then you got another area here. So I hope that's clear. Demand there, demand here, and demand there. I don't really like to see that happen because look, what's stopping price from piercing into all of this area? If you've got your stop below here, you're going to be in a very vulnerable position. So I like to see fresh. When I say fresh, I mean having little connection to any any structure. What I'm looking for, as I said, guys, I'm looking for decision points. I will show this on the live charts very, very soon. I can actually show this right here, actually. So we've got a resistance here. Imagine price is doing this, and we come down, and we've, bad example, guys, but we have a rally-based rally form here. Look, this is a very bad example. It should have been an uptrend forming there. But then we push up. So I'm looking for the decision point. The decision point to break that area. This to me shows strength, and this is what this leads us nicely onto the location. So when I talk about location, I'm not, as I said before, I'm not talking about the location within the trend. I'm now talking about, although the trend location is very, very important, I'm talking about where it's formed in regards to, no problem, the kid. Where it's formed in regards to market structure. So again, keep that in your mind, decision points. I'm looking for decision points on the chart. I'm not just looking for any area that's formed some momentum and we can trade that upon return. For me, we can't. We did the zone break. So the questions you need to be asking yourself is, did the zone break anything of note? For example, did it break a round number? So we know round numbers are very popular. Did that area break around? Let me try and draw a clearer example. Let me get rid of all this now, and I'll draw a clearer example for you guys. So we have a clear resistance here. This could be in the past, right? A clear resistance in the past. Price is rallying higher, higher high, higher low, higher high, higher low, higher high. Yeah. Okay, so now we're getting small consolidation. We know there's a resistance. As technicians, we need to know where we are on the charts. We need to know what we're coming up against. We need to know what's in the past. So we know there's a resistance here. Resistance here, okay? I'm going to ignore the price action prior, but we know there's a resistance, a defined resistance. And now we know this area here. So remember, the rally-based rally is a defined up move, a subsequent consolidation, the base, which follows up with a move to the upside. Now, that move to the upside, that inefficient move to the upside, had enough, for lack of a better word, oomph to completely obliterate that resistance. Now, it's when price returns to this area, I know I have a relatively high probability trade. Okay, so I'm looking. So when I say where am I? Location. Yeah, location. I'm looking for where it formed in the overall. How can I put this? In overall market structure. So not so much the trend now, although as I said that's important. It's to do with the market structure. So this resistance could even be another supply and demand, another supply area here. It could be a round number. It could be a moving average. You know, the 200-day simple moving average is very important. A lot of traders look for that. Now, if this decision was to break through that, we know there's a high probability that this inefficient move that broke through that is going to fill, okay, and likely give us a reasonably decent trade. Location, so base formation. Now, you will note the base formation. This is the base. So there are a number of ways, I guess, the base can form. There is one where there's just a small kink and it goes up. You will see some of the examples I show later that has this. For me, I prefer more of a defined base. It's almost like a flag, I would say, to a point to form. But, you know, what we don't want to see is disorderly bases. So we don't want to see price doing this and this. There's no way you can draw a base for this. It needs to be defined that the highs and lows need to be relatively equal. Yeah, so there's not much really I can say on that. So look, so do take into consideration the formation of the base. So we have a question from Yasmin. Where would you set your entry and stop loss, TP, take profit? Yasmin, I'll go over that very shortly. Time is really creeping up on me, actually. So I want to get onto the live charts as quickly as I can, and we'll discuss that there. So next up, approach. Now, this can be quite difficult, the approach. There are two types of approaches I look for. As there is an inefficient move, I'm looking for this area to fill relatively quickly. But what it can do, what price can do, is compress. It's compressed like this. Now, this is a really good sign in my experience. And if the area is here, imagine the RBRs here, okay. And if price is compressing, what is it doing? It's clearing out sell orders as it drops. So what this is price compressing down. So think of it almost like as a wedge forming down. So as it drops, it's filling any unfilled sell orders, any unfilled sell orders, any unfilled sell. And what do you think is going to happen once these bids are tripped? Boom, price rallies with aggressively. It can rally aggressively. But again, if there's another let me just get rid of that. There's another one. Obviously, price, the inefficient move. Now, if price slams into the demand here, this is another trade that I would consider for sure, because this will scare a lot of retail traders, particularly on the lower time frames, and we'll just buy into that. And what they'll do is they'll sell as that inefficient move comes down, and on the lower time frames, that'll be some very strong candles, and we can buy into that. Okay, so there's two approaches I look for, without going into too much detail with that. And finally, multi-time frame analysis. For anyone that follows my analysis on a regular basis, you will note I always look at the markets from a multi-time frame approach. I will try to go over this more in detail on the charts, but as I said, time is really creeping up on me. So guys, look, with that out of the way, are there any questions before we move on, other than Yasmin's question regarding, look, I can answer that now, Yasmin, actually, because you seem to be the only one that's got any questions. So look, for the rally-based rally areas and drop-based drops, traditionally, traders look to enter at the upper edge of the base and position stops just below the base's configuration. So how many pips? That again is up to you. That will be up to the trader, but traditionally, again, it's between 2 to 3 pips. Now, you should always look at where your RBR is positioned. If there is a support and resistance just below this somewhere, you know, you have to use common sense here. You have to use common sense. The price could easily whipsaw through that and take out your area and test that support. So you have to always take into consideration as to where you place your stops. I hope that answers your question. That's a very basic definition, but again, you can look within these areas. If this is a H4 zone, you can go down. This is again using multi-time frame analysis. You can go down to the, say, H1, M30, and look within this area. Are there any other rally-based rally areas within this zone that you could enter from? So they could, you could halve your risk potentially. If there's an area within this zone here somewhere, you could potentially place your entry at this point and place your stop as you would beyond the higher time frame zone. I hope that answers your question, Yasmin. I know it's very brief. From Andrew, you're saying a lack of volatility on approach is best. Volatility, am I saying it's best? It's a very good question. I am not saying it's best. I'm saying either is okay for me, Andrew, if I'm being yeah, so either is okay for me. So what I look for, as I said, I'm looking for this would be considered as a volatile. If you look on the charts, if you see an example of this on the charts, price compressing, this is what you would call a volatile move. So volatility and momentum is different, right? I'm sure we all know this. This is a momentum move. This is a strong defined move in one direction. Volatility is the action between, you know, I'm trying to think of the correct way to define this. It's not so much the direction; it's more of the the reactions between, yeah, I'm trying to think of a good way. You've put me on the spot there, Andrew. Volatility, you know, is the difference, is not the same as momentum, but it's more of how volatile, how much the market moved up and down during that that period. It's not so much direction. So for me, to answer your question, a lack of volatility, it can be both. So I really like when I see these formations form, because I know that with a high probability, the sellers are likely very weak at this point where I want to be buying. Okay. Okay, we have a question. Andrew, I hope I answered your question there. Another question from the kid. Do you use any other indicators for confirmation? There are a number of indicators you can use, of course. I'm a big fan of the RSI, particularly if these areas are hit when we have, you know, with the RBR and rally-based rally, you'll normally find that we have a technique known as hidden bullish or bearish divergence, which is usually formed for continuation moves. So I look for that to form at these areas. This can be a way of adding extra confirmation. You know, some traders even look at candlestick patterns, you know, the hammers, bullish and bearish engulfing formations and stuff like that. Again, this is trader dependent, and this is something you would need to back test to see if it adds any weight to your system. Also, you can look at Fibonacci. I'm a big fan of Fibonacci areas, Fibonacci levels, excuse me, and harmonic formations, you know, the AB equals CDs and Gartleys and BATs and things like that. I hope that answers your question. Oh, I've lost the questions. 1 second, guys. Yes. Okay. Okay, excellent. So right, I think I've covered everything there. Any questions on this? We can cover this on the, let me just remove that, on the live charts. Let me just spin things over to the charts. Just give me a second, guys. Okay, so right now you should be seeing the euro pound on the M30. Now, for the guys that were with me on the in part 1, you will remember right at the end, I can't remember who asked me, so I think it might have been, I'm not sure, there was someone here that asked me, do I have any live zones? And I quickly saw this out of the corner of my eye, literally out of the corner of my eye, and I highlighted this area here. Guys, I hope you can see the chart I'm talking about. So look, this is the area I highlighted, and why I highlighted this area was because of this. Again, this is a kink. I'm not a big fan of these, even though it was a decent area in my opinion. But what it did is it pushed through this supply. Now this is another good supply in my opinion. As you can see, price dropped lower, broke all of these lows here. Now what's important about these lows is we formed a defined high at this point. So there's a lot of selling, buying interest coming off of these areas, and with that there'll be a lot of traders in pain after this move. That's what I'm looking to. Sounds bad, but I'm looking to take advantage of that pain. And as traders, you need to be as well. So what I did not see though, it was this area here. Because it was quick, it was literally 2 minutes towards the end. I did not see this area here, which I should have done. This is the actual decision point that broke this supply. See, we had a decision point to actually push into the supply. Then we formed another decision point, a rally-based rally, to push higher and break all of these highs here at this point here. What happened? Price come down, price retreated and filled this inefficient move and tested this demand here, and then rallied higher. All right, it didn't give us the best of risk to reward, but it's certainly a trade that you could have profited from. And as price come back again, tested it again, and then finally broke it and then retreated lower. What's interesting about this? Let me try and change the color. I don't think I can actually. Yes, I can. Give me a second, guys. Just want to change the color so you can see it. Okay. That's better. So what's interesting is this is the initial area I highlighted, if you remember, guys, and this broke straight through. Why did this break through? If you remember, I like to see these areas fill almost immediately, which it didn't. We formed another decision point above this. So I would have, at the time, I would have expected this to break. You know, guys, it's easier saying that in hindsight, but I would have done because this has already reacted here. So we broke lower and we reacted off of this Quasimodo support level at this point here. Now, with this buying pressure coming up from here, we retested the lower side of that area. This was an important base, and we've seen it at this point, and we've seen it at this point, and price is now returning to this area. Would I expect another reaction to form here? Probably not, to be honest, because we've had some seriously good reactions from these points here. It's like chopping at a tree, guys. So if you chop it too much, it's going to eventually fall down, and this is what I think is going to happen here. So yes, this is just to explain where we left off with the Euro Pound M30. I'm not sure if any of you guys can remember this or looked at this following the presentation. I don't see any questions. Nope. Okay. So do we all understand what happened here? Okay, great. All right. So my next example is on, just really quickly before I go to some live charts, is the, whoops, let me just get rid of this marker. Erase all drawings. Yep. Okay. So my next example is on the, brilliant. Okay, excellent. So my next example is on the Aussie dollar, sorry, Aussie yen, H1, and it's an H1 and an M15 example. This will show why it's sometimes beneficial to go down to the lower time frames if you have a kink. So let me just reiterate this point. If you have a kink, you can call it a kink demand if you want, but it's still a rally-based rally in my opinion. So we have a kink form here, and we have a decisive move that broke these lows, highs that were the origin of the move to the downside. So knowing this, we know we have a potential trade. Now, if I remove this smaller area, this is the kink. As you can see, we actually missed the zone. Is there a reason for this? There certainly is. Now, if we go down to the, let me just put this back. Oops. Oh, there we go. And now, if we go down to the M15, so every time we see a kink like this, there's a very good chance it's what we call stacked demand. There's going to be some demand areas that you're going to miss. So it's always a good idea to check out the lower time frames. By doing this, you would have seen that, as I said, there is some stacked demand going on here, and there is a point here. If you see this point here, which reacted nicely, you could have been really, really cheeky and just gone for this area here, which still would have. Let me just remove that so it's clear. You could have been really cheeky and gone for this high here and this low here, and the risk to reward at this point would have been just incredible, in my opinion. And you see there's actually another supply area at this point here that reacted. I hope you guys saw this. Not the greatest of areas because it reacted off of this resistance, but it did break. It did form a decisive move past this low and reacted off of this area to give us another trade off of this demand here. Okay, so we have a question. I missed the part one. Could you show how the supply range is found, the upper and lower bound? Yasmin, I think I've just shown that on the slides. If you're talking about the rally-based rallies and drop-based drop areas, if you're talking about that, maybe watch the. This is an example of a drop-based rally here. So we have the drop, transitions into a base, and then a subsequent drop. Now, if that's not clear enough, maybe consider watching. There's a recording of the webinar on the FP website. Consider watching that, or consider watching the review of the recording of this webinar. So guys, sorry Yasmin, I can't be of any help. I'm really under pressure here with time now. Right, guys, do you have any charts you want me to look at? At the beginning of this presentation, I did say to note any charts you want me to look at, and we'll go over them together. We have a question here. What time frame do you favor for this strategy? So I'm a big fan of the H1 time frame. But again, guys, I always, there's quite a few questions coming. There's I always look at the other time frames as well to note where I'm coming from. But the H1 is a personal favorite of mine. The M30 can be good, but I tend to stick to the H1 time frames for this. I hope that answers your question, the kid. We have another question. Is the zone you marked called zone resistance become support? Which one are we talking about there? There's no support or resistance on these charts here. So no, the answer to that question is no, because there's no support and resistance. Are you talking about the euro pound? Now this for me, this is a good example. This for me is a demand turn supply. This is not yet a support or resistance base. The only time this will be a support or resistance base for me is if we come above this area. Now we're looking at a support and resistance area potentially forming in the future, if that's what you were talking about. Okay, Travis, euro dollar. Okay, let me just quickly see. Okay, let me just bring that up. Euro dollar. On the daily, what time frame, Travis? Any time frame you're looking at? Okay, euro dollar. Okay, I haven't got a time frame yet, but we have been seeing some reasonably decent moves. So there was, I think, ping down to no time frame, Travis. Oh, do we have a time frame? Oh, H4. Okay, excellent. Okay. What area are you looking at, Travis? Can you maybe highlight which area, the values, and I'll okay. So we have Daniel. We have a question from Daniel. Just read. What is the name of the course you do again? It's CMT. It's the Chartered Market Technicians course. Guys, if you're looking into that, this will really open your eyes to technical analysis. It's incredibly broad technical analysis, and it's an incredibly intense program. I'm on the final stages now, thankfully. But do look into that if you're interested. It's quite an expensive course, and as I said, it's a very intense course. Level 2, which I completed a year and a half back, is incredibly intense. They even said it's harder than level 3. So, but level 1 is a real eye opener. You'll see people drawing. You'll see traders drawing flags and pennants and wedges on the charts, but as per textbook, they're not flags or pennants. But look, guys, I'm not here to criticize anyone. If something like that, if a particular formation works for you on a chart, then the more power to you. If you can make it work and you make money from that, who am I to say that it's wrong or right? So Travis, I'm still waiting for a time frame from you. Sorry, not a time frame, an area that you want me to look at. What is the average cost for this CMT program? The average cost for the oh, you put me on the spot now. I cannot remember. It's quite expensive. You're looking at quite a few $1,000s for the course. The book alone is, not 50,000, no. It's the book alone is $300, and it's 5,000. Yeah, you're looking at least around 5,000, I believe, dollars, which it's around 5,000, I would say, for the whole course. I am long until, from Travis, I am long until 120. Your thoughts? Okay, 120. Where did you get long, Travis? What was the position? And did you take that based on supply demand, or? Because I know we've just broken a demand area on the euro. but your trade is doing very well at the moment, and your long diagonal line on the daily. Okay, let me just ping up. Oh, I know where you're going. Yeah. I had this marked as well. Oh, hold on. We've actually broken. Which? All right. Maybe you can send me an email with that trade, Travis. I'm interested in that. What diagonal line you've used? Was it this one here? Maybe higher. Okay, I'm not sure. Oh, are you talking about this one here? Yes, you are. Yeah. Okay. Yeah. I gotcha. I know what you mean. Yeah, that's the one. Okay, cool. Well, it's doing very well for you at the moment, and you got in a very, very good spot. So in terms of supply and demand, I'm not sure, to be honest, because we did actually break a H4 zone. If you see that area here, this is not the best of zones, so it might not mean anything, but it's still, it did react, as you can see, a minor reaction, but we did actually break this. So the points I would be looking for is the Quasimodo. I've actually noted this in my analysis as well. The Quasimodo, let me just highlight that real quick. The Quasimodo, that's probably going to confuse some guys. So let me just draw that properly. The Quasimodo resistance at this point here, I'll be looking at this area here as potential resistance, particularly if we get above these highs here. As for supply and demand, I don't really see anything going on right now. No, I don't see anything going on. But this is a really nice area that I also have highlighted on my analysis. This area here, and this converges with your 120 as well, Travis. This is a really tasty area of supply, but we have drove away from it quite a bit. The interesting thing about this zone is these highs here. Now, there will be traders with stops above these highs, right? There will be longer term traders with stops above these highs, and there will be breakout buyers interested in buying above this area. So if price comes up and breaks through this, it's going to be a breakout buying, strong breakout buying interest going into this, and hopefully we can traders will look to sell from this zone and potentially take advantage of all those what's called a bull trap. It traps the breakout buyers. Okay, any more charts? There was a couple more. Sorry guys, I'm just trying to look through your examples. I can show you a couple real quick if you want. I've got one. Oh, not this one, just really quickly. So I've got one on the Aussie, Euro H1, but again, this is a kink sort of demand. So we go down to the M15. So this is a really nice area. So we can work with just the kink here. You might want to include the small kink there, but overall, this is a really good area in my opinion, and something you should keep an eye on, because look what we broke. We broke all of this. This is a strong move. This is an inefficient move, breaking through all of this. Okay, so this is something I would be looking at as price comes down. What would be nice is if we, as I said, come down slowly, attract, the theory behind what I said with the approach. Let me just try and draw this on. 1 second, guys. Pen. So the theory behind this approach is this movement coming down like this are the larger players buying into moves undercover. So they're buying, because as you know, larger players cannot just, like us guys, we can just put in an order and it will be accepted into the market. They cannot do this. These larger players cannot do this. So what they're doing is they're putting in their small orders here, buy orders, small buy orders. And then when they get to this area, they're higher, okay? So they're buying, just small buy orders, okay? And as price is coming down, the lower lows, lower highs, they're buying into the lower time frame sells, right? Because we're forming almost a trend, yeah? I hope that answers your question. Sorry, there wasn't a question, was there? I hope that answers your question regarding the approach. This is the type of approach I like to see. But again, if there's a volatile, not a volatile, a momentum move back into this, I would still consider this zone. Let me just erase that really quickly. There was one more I just wanted to show really quickly. Dollar Swiss. Now this was a good area. This was a really nice area. but it's no longer active. Look at this for a supply area, rally base. This is a drop base rally, but look at the momentum derived from this dollar Swiss H1 chart. The momentum was just incredible. Now, when I initially marked this up, the price was reacting off of this, excuse me guys, off this Quasimodo. Now, if price would have come up from here and attacked this zone, this might have been an area to consider. Now, something to look out for, as I said, always consider your surroundings, right? So here we know there's something going on here. So if you look closely, there's actually a Quasimodo resistance at this point here. Price, I have seen on many occasions, takes out this area, leaving all the supply traders in with issues, and comes and reacts off that Quasimodo. So what they're doing is there's sellers. We're going to be interested in these points here, right? But you need to take into consideration your structure. So we know as supply and demand traders, stops are going to be placed above here, and we also know there's a Quasimodo resistance in place. So just use common sense, guys. If you know there's an area just above this zone, this has fake out written all over it. Okay, this area here. Let me just remove it. This area between here and here has fake out written all over it. There are stops between here. So if price came up and rallied through that area to test this Quasimodo, we know we're in a pretty good trade. Now, as for confirmation, you could just look for a bearish candlestick formation. Simple as that. Bearish candlestick formation and sell into that. Okay, so this is a good point of taking into consideration your overall surroundings. But this for me now is not really an ideal area because of the length, the duration we've been away from the trade. Now, just as a quick point, Quasimodo support, right? We had literally no reaction now, literally, according to this chart, zero reaction. So we've come through. Well, we did get a minor reaction, I believe, that was happening, but it's nothing to write home about. And we've broken through that decisively. Now, traders should watch out for this is not supply and demand, guys. This is just a bit of a divergence here. But we could see a potential selling form off of this area. And I'm pretty sure there'll be a 38.2. No, there's not. Okay, it's relatively close, but that gives us a zone to work with. And also, we have the supply there. So we have quite a lot of confluence to look out for there. We have the supply area here. So once you learn to read charts and learn to read the actions, you can see these sort of setups forming. So we have the kink drop base drop. We have a 38.2% fib retracement at that point, and we also have the Quasimodo support turned resistance. So there's an ideal area to be looking at this point. Now, this was an example I wanted to show you. This is an ideal example on, again, something, it's played out, but you can see the strong move up and the relatively strong move down. Very simple, very basic, but look what we broke. We broke through all of this stuff here, all of this. And why is this high important? Because it was the origin of the extreme low being the low of all of this. Okay, so we know we've broken something of note, done some damage with this demand. So we come back and we rally higher. I'm just trying to think if there's any others. All right, so look, guys, let me just see if there's any other. Okay, we have pound yen. Let me just have a look from Andrew. H1 sell on the 6th, tested and sold off nicely on the 7th. Is that a good example? So the pound yen, just let me have a quick look for the, let me just change the chart actually. Pound yen on the H1 on the 6th. Are you talking about this area here, Andrew, I assume? Yeah. This is quite a nice area, actually. Yeah, very nice area. But it didn't touch. On this feed, it didn't touch. I mean, what area? Was you looking at this area here? If you was, fantastic. I mean, that's an example of stacked demand, so stacked supply, sorry. But it's still, as you can see, there are a number of supply areas to take into consideration here. All right, there's also this area here, the main main body of the area. So for me, if we were selling this, which was an ideal sell, by the way, I would have placed stops above this. Just to be, I mean, depends how aggressive and conservative you are. This would have been my stops would have been above here and an entry on at this point here. Andrew, I assume, I can't see any reply from you, but yeah, I assume this is what you were talking about. Are you actually short this area? Because if you were, again, guys, this is another example of a good approach. So for any of you that also follow the harmonics, the basics of a harmonics is an ABC, right? An AB equals CD. Sometimes people call it ABC, which is fine. Yeah, it's totally up to you how you refer to it. But Scott Carney's a very good resource if you're interested in that. So the ABC, you can just simply look for the 100% Fibonacci projection for this, which I'm not sure if it did. Yes, it did. Look at that. That's absolutely perfect. See, with this, we had also the confluence of an AB equals CD bearish formation. And the great thing is we broke so much. We broke, look at this. We're actually in the immediate biases to the downside. That's a brilliant example, Andrew. Excellent example. And look at the move we got from that. Now, if you were an aggressive trader, you could have entered short here and place your stop above here. The risk to reward would have been unbelievable, is unbelievable. Now, what did we break? This is the question. Look at that break. This is what we're looking for. We're looking for a decisive move to the downside. Now, we had this demand here, which was, you know, it's half-hearted, but we also had this small kink to consider there. So look at what we broke. We broke this, you know, this considerable area. This is an area of interest, obviously this demand, because it broke this high. So this was, yeah, perfect setup. Really good. Really like that one. I wonder if we also had additional Fibonacci retracement confidence, which we probably did on the 50-ish, I would have said. Yeah, around 50. That's not a fib level, guys, just to be. But look at the confidence we have within that area. That's brilliant. Love it. Yeah, I really like that. I'm pretty sure there would have been some RSI. You know, let me just check. Okay, no RSI confidence really. No, there's nothing there for the RSI. But yeah, Andrew, this is a really good example, and I really like this. Yeah, so it's always good to look at your surroundings and how it forms. But yeah, even stacked supply can work. Just depends on where you want to place your stops and how aggressive or conservative you are. Okay. Oh, we have a comment. Stochastics topped out on that pound yen. Did it really? Okay, I don't follow the stochastics. I'm a big RSI fan more than anything. It topped out, did it? No overbought signal, so we have more confluence at this area. Just trying to see if there's anything else with this zone we could have added. So with the I'm not sure if the BC project, but I don't really need to say anything else on this. And I mean, look, this was just unbelievable. For any round number traders, you would have been absolutely cursing this move, because look what happened. We rushed. This is just a perfect example, guys. If you want to screenshot this, I would really recommend this. But we smashed through not only the round number, but also this demand as well. But what happened on the retrace? We know traders are going to be interested in selling at this point, right? We've got some sellers coming in here trying to short the underside of this. They get taken out. So they think, all right, cool, we're going higher. But there's also going to be sellers going on selling at this point here. The confusion around this area is just obvious to anyone that looked at charts for a long time. So there's going to be sellers at this point, and there's going to be protective stop loss orders above here. Now, those protective stop loss orders, once tripped, will be buy orders. Now, selling into those buy orders is where we want to be. These offers, these pending sell orders are where we want to be. Okay, this is a clear decision point with great, you know, location in terms of psychology with the round number there. We know sellers are going to be in pain here. We know also, look at this, even with the retest of the level, we know buyers are going to be coming in at this point here. So there's going to be breakout buyers coming in above this, thinking that the 153 level is going to hold. but it doesn't. It comes off of our level and completely demoralizes anyone that's trying to you know, it completely leaves sellers confused at this point, and also forms a perfect bull trap. Thank you for that, Andrew. That was a perfect example. And it recently kicked, it was yesterday's example. Yeah, excellent. Well, another comment, we also have the MACD crossed over, the 0 line. Yeah, brilliant. Perfect example, really like that. Hi, we have one comment here. Hi, when identifying supply and demand, do we care how much time the market spent in the zone? That's a good question. I would like to see a quick reaction, to be honest, like this one here. If it's consolidating, that to me tells me it's indecisive, and I would try to look to get out of the zone. You should have that in your trading plan, guys. If a zone does not give you what you want in a relatively quick time, because we are trading H1, guys. We're not trading the daily or the monthly. If it doesn't give you what you want, if it doesn't get you to a position where you can reduce risk to break even, I would look to potentially get out of the trade. Again, you should have this in your trade plan, guys, in your trade management. And how long is up to you guys, but for me, I would not like to see a consolidating, consolidation formed within within the supply. So guys, I think I've got round to all of the questions now. If I haven't, I apologize. I hope this has been of use. I've thoroughly enjoyed the supply and demand webinars. It's something I'm interested in. It's something I use. So are there any questions, just real quick? Okay, I don't see any other questions. Yeah, so look, guys, this was a really good session. I thoroughly enjoyed it. If there are any specific topics you want to suggest to me and the team, please send an email to marketanalyst@fpmarkets.com. Guys, if you have any questions about the webinars, if you disagree with something, or if you want to confirm something, please do also send me an email, and I'll happily get back to you as quickly as I can on that email. Also consider registering for the FP Markets Telegram channel to get instant updates. So look, upcoming webinars to be on the lookout for are Crafting Your Trading Strategy and Advanced Fib Strategies with Isaac next week. Well, the following week, I will deep dive into chart psychology in a two-part series. Now, chart psychology will also incorporate all of this supply and demand techniques, all of these supply and demand techniques I've shown here, but the psychology is knowing where the orders are, is knowing where, not knowing 100% where the orders are, but knowing with a high probability where the orders will be. Where do traders look to buy and sell? Can we take advantage of that? So for instance here, look, sellers here, we know for a fact there will be stop loss orders above these areas. We want to take advantage of them if we know we've got a high probability zone according to our methodology. Okay, so this is all about psychology. It's going to go in depth into the orders, the different types of orders, the basic orders that traders use, and what we need to know to take advantage of those. As I said, this will be a two-part series, so it'd be great if I could see some of you guys there. Also, at the end of the month, I have a backtesting webinar. There's been a lot of questions asked about how do I backtest. I assume most of us are discretionary or partial discretionary traders, so I will focus on this, but also touch on some system testing as well. And that's at the tail end of July, if you're interested, guys. On that note, that's time up, guys. Thank you very much for taking the time to be with me today. I've thoroughly enjoyed it, as I said. Hope you took something from it. And as I said, any questions, please feel free to fire them over to me. So have a great day, and I'll see you all again very, very soon. Bye-bye.